Hi, everyone. Welcome back to Introduction to Accounting. So, we're picking up where we finished last week, and we're going to go more into depth on the accounting process. Now, again, before we begin, let's give a little background on myself. So, my name is Raj. I have a Bachelor of Business Administration with a concentration in accounting. I articled with a Big Four accounting firm where I obtained my CPA designation. And I have experience both with public and private companies in the mining, energy, retail, and private services sectors. And I've also worked as a college instructor and I've taught courses including introductory accounting, intermediate accounting, taxation, and accounting software. So I'm really looking forward to putting my knowledge into informational videos for you guys to watch and learn at your own pace. So today we're continuing our accounting introduction. So we will learn about debits and credits. We will then go into journal entries. We will go over the general ledger and chart of accounts, and then we'll finish off with the trial balance. So recall accounts. Accounts are an individual accounting record of specific financial statement element. It can be organized as a T. So you'll see when you look at the T, we'll have a title, and then we have two columns. One is labeled debit and one is labeled credit. Now, debit means left, credit means right. We can also abbreviate the words. So debit can also be abbreviated as DR, uppercase, and DR, lowercase. Credit can be abbreviated as CR, uppercase, and CR, lowercase. And if we have more on the debit side via the credit side, we will have the account in what is known as a debit balance. And the same thing will occur vice versa. If we have more credits than debits, then the account will be in a credit balance. Now, what does it mean to be a debit or credit? So when you debit the account, we're going to enter amounts into the left side of the T account, and that will be known as the debit side. When we credit the account, we are going to enter amounts on the right side of the T account, and that is known as the credit side. Now, the question is, how do we know where to enter the amounts? Now, it's going to depend on the actual account itself. Now, there's a normal balance depending if the account is an asset, liability, or owner's equity account. If it's an asset, normal balance is going to be on the debit side. If it's a liability or owner's equity, normal balance is going to be on the credit side. Recall the accounting equation where assets equal liabilities plus owner's equity. That means all of our debits will also equal all of our credits. Now, if we go into each individual financial statement element, okay, so we'll start with assets. We'll talk about what it means to have a normal balance. So assets have a normal balance on the debit side. So every time an asset is increased, we're going to record that increase on the debit side. But if we have a decrease to the asset, we're going to record that onto the credit side. Liabilities work in the opposite manner of assets. So any increases to a liability will be recorded on the credit side, and any decreases are going to be recorded on the debit side. Owner's equity behaves in the same manner as liabilities. So increases will be recorded on the credit side, and decreases will be recorded on the debit side. Now we're going to go into some individual accounts that sit under owner's equity. So we have owner's capital. The normal balance for owner's capital is a credit balance. So when the owner, for example, invests, so it puts money into the business, that will be recorded on the credit side. But drawings, which is another component of owner's equity, that's going to be normally in a debit balance. Now, that's a separate account altogether, and that's going to track money that's coming out of the business when the owner takes money out for personal use. Okay, we discussed revenues is also a component under owner's equity. Its normal balance is a credit balance. So increases are recorded on the credit side and decreases are recorded on the debit side. So if we have a sale, that's going to be considered an increase. That will be recorded on the credit side. But let's say we have to give a customer a refund. So that's going to be a decrease of a revenue. That's going to be recorded on the debit side. Expenses, so they generally decrease owner's equity. Generally, they should decrease owner's equity. So expenses will have a normal balance and a debit balance. So increases, so when we have expenses, they're going to be recorded on the debit side. When we have any decreases, so let's say we get a refund on an expense, that will be recorded on the credit side. Now, the summary of owner's equity is that any increases by the owner in terms of investments, any revenues will be considered increases to owner's equity. They will be credits. Decreases, on the other hand, such as owner's drawings and expenses, will be recorded as debits. Okay, now that we have an introduction to debits and credits, we can now discuss journal entries. So, journal entries are known as the double entry of accounting. What does that mean? So, what that means is that each transaction must affect two or more accounts. That keeps the accounting equation in balance. And double entry means that our debits must equal our credits. Now, the recording process starts with analyzing each transaction for its effects on the accounts. We will then enter the transaction information in a journal, and posting is then transferring that journal information to the general ledger. So the first step, analyze the transaction. We first need to assess, has there been an economic transaction? Did an event occur that has a monetary impact? We would examine source documents, such as a bill or receipt, that will help us determine which accounts are affected and by what amount. We will then transfer that information into a journal entry, the book of original entry. The journal entry will show the debit and credit effect on the accounts. Most journals are known as general journals, which means that they affect the general ledger. The journal entry will give us information as to the date of the transaction, the accounts that have been impacted, the debits and credits in relation to the impacted accounts, and they will also generally offer an explanation on the transaction and any references as applicable. Now, what are the journal entry advantages? Well, it contains one place for all transactions to be recorded. They're recorded in a chronological manner, and it helps us prevent or locate any errors. A journal entry looks like this. So we will go over the following two journals. So let's say an owner invests cash into the business. So this can be translated into a journal entry. Cash is going to be increased, right? Because an owner is investing cash into the business, and owner's capital will also be increased because if you can recall, investments increase owner's capital. Okay, so cash is increased on the debit side because it's an asset account, and all increases to assets go on the debit side. Owner's capital is part of owner's equity, and that is increased on the credit side. So the credit is going to show an amount of 15,000 because owner's capital is being increased. Okay, and then don't forget the date is also entered. Okay, the second transaction is that we buy office furniture and we use cash. Okay, the amount of the transaction is $5,000. So office furniture is an asset. Okay, it's being increased. Assets increase on the debit side. So we'll see $5,000 debit for office furniture. And then cash is being decreased. Why? Because we paid cash to buy the office furniture. And then assets decrease on the credit side. So we'll have 5,000 being entered on the credit side. So first of all, let's analyze both transactions. You can see the date has been entered for both transactions. Okay. And that date is entered into its own column, the date column. Okay. Number two, for both transactions, you'll note the debit account is entered first at the left margin and the amount is recorded in the debit column. So the rule is all accounts that are being debited have to be entered first. When we write a journal entry, we always put the accounts being debited first. And it doesn't matter if it's an asset or a liability. It's just whichever account is having the debit, that will go first. Then we will show the accounts that are being credited. Okay, so the accounts that are being credited will be indented, and then that amount is recorded on the credit column. We'll then enter a brief explanation of the transaction, and you can see that for both transactions, there has been an explanation given. We will also leave a space between the two journals. Okay, and if you look at number 5, there is a reference column, and then that reference column is used when the journal entries are transferred to the ledger accounts. So there's simple and compound journal entries. A simple journal entry only involves 2 accounts. A compound journal entry, on the other hand, will require 3 or more accounts. So now let's talk about the general ledger. What is the general ledger? So we had briefly shown you a T account. Now, a T account can be considered an informal ledger and is going to be tracking the balance for each account. However, the general ledger is the actual formalized manner of tracking each account balance. So it's going to show the balance for all the accounts. It's going to track the transactions for all the accounts, and the transactions are entered chronologically. And then the general ledger itself is ordered in terms of presentation. So that means all the asset accounts are listed first, then the liability accounts, then owner's capital, then drawings, then revenue, and then expenses. The general ledger has a 3-column form. So there's a separate column for all debit amounts, all credit amounts, and then there's a separate column that tracks the ongoing balance. The balance is calculated after each transaction. And then there's an explanation in a reference column as well, which gives us additional details on any transactions. Now, this is an example of a general ledger. It's quite complex, so don't worry about knowing how to complete a general ledger to this level of detail at this point. This is just provided as an illustration. So first you'll see there is a header. We have a company called Luggage Store. It will then state the report name, which is a general ledger report, and it tells us the date. So it's from March 1st to March 7th. Okay, and then you can see where I've highlighted in purple, we have 2 accounts being listed. First, we have the bank checking account. Okay, so that's an account. And then the second account is accounts receivable. Okay, so there is a ledger for each account. Then in green, you can see that we have transactions for each one listed, and these are the changes in that period. Okay, then in red, we will have a balance. Okay, so in this case, we have opening balances that are carried forward from a previous period. And then we'll have an ending balance, which is in blue. Okay, so you can run the report at any given dates, and it will give you an opening and ending balance at any point in time. We will look at it further. So again, if we look at the same accounts, you'll see we have transaction dates for each transaction. So the dates are listed. Okay, they're all listed in chronological order. There are journal entry references for all of the transactions. So if we want to investigate further, for example, journal entry 3, we could go to journal entry 3 and look at the original book of entry to see what resulted in this amount being recorded. Okay, and then just to repeat, we'll have an ending balance, okay, for each account. And then that ending balance will be the opening balance for the following period or date range. So that brings us to then posting. Posting is when we transfer the journal entries into the general ledger accounts. So posting accumulates the effect of all the journalized transactions into the individual accounts. Now, the steps involved in posting, okay, are the following. First, we have to select the correct account in the GL that has been debited. Then, once we locate that account, we're going to enter in the date, the journal reference, and put in the debit amount. In the reference column of the journal, we're going to write the account number to which the debit amount was posted. So we'll discuss this in a couple more slides. Each account has its own number. So when we transfer the general journal, so the journal entry to the ledger, we'll go back to the journal and indicate what account number that journal entry was posted to. So continuing with posting, we would then select the account in the GL that has been credited. Once we've selected the correct account, we're going to enter the date, journal reference, and credit amount. And then in the reference column of the journal, write the account number to which the credit amount was posted. Now that we've entered in all the debits and credits, in the reference column of the general ledger account, we can also indicate the journal entry. So posting guidelines. Posting should be chronologically performed. Okay, and posting should also be done on a timely basis so the general ledger stays up to date. Now, when you're doing journal entries manually and posting manually, this is really important. However, when you're doing this on accounting software, for the most part, this is done automatically. Normally, accounting software will post all your journals. Sometimes there is an additional step where you have to press the post button, and in either case, it should be performed regularly. So chart of accounts. Chart of accounts is another report that is created that lists all the accounts and account numbers that identify where the accounts are in the general ledger. So it's a report essentially listing all of our accounts. It provides the structure of the accounting information. The numbering system is used to identify the account, and it will start with the balance sheet accounts, followed by the income statement accounts. So it's going to follow the same ordering as the general ledger. So this is an example of a chart of accounts. So when we run the report, it's all going to list all the accounts like below each other. In this case, they're side by side. We're going to have the company name and then the report name will state chart of accounts. And then we will have all of our accounts by their name and account number listed. So generally, assets start with account number 1, liabilities start with 2, owner's equity starts with 3, and then revenues and expenses, it can vary. Sometimes they start with 4, sometimes revenues start with 5, and then expenses can start at 5 or start at 6. So it kind of depends on the company's structure and how many accounts that they have. So you see, we have some asset accounts like checking account, accounts receivable, and then liabilities will have accounts payable. And you can see all the account numbers used are unique. So there will be no duplicate account numbers used. Now, the trial balance is another report that's really important. It's going to list all of the accounts and now their balances at a specific time. So we can run it at any date, but is generally prepared at the end of an accounting period. Now, accounting period can be for 1 month, a quarter, or a year. So a trial balance will always be prepared for that accounting period. The accounts are listed in the same order in which they appear in the ledger. There's a left column for the debit balances, and then there's a right column for all the credit balances, and the totals of the two columns must be equal. So they have to balance. So an example of a trial balance. Okay, so this is just the beginning of a trial balance. So you'll see we'll have the company name, we'll have the report name, trial balance, and then we'll have the specific time, so the specific date. Now you'll see the 4 columns. We have one for account number, then the account description or account name, then we'll have a debit and credit column. Now the account numbers, they're all ordered, okay, and that ordering matches the GL. Okay, now if we look to the end of the trial balance, because a very long trial balance, you'll see the debit and credit columns, the totals will be the same. Now it's really important that it balances. If it does not balance, something went wrong. Something went wrong. And as an accountant, we like things to balance. It gives us some assurance that the numbers are correct. If it doesn't balance, like I said, something went wrong somewhere down the line, and then we would need to investigate. So there are limitations to a trial balance. So even though the trial balance balances, it doesn't necessarily mean that all the numbers in there are correct. Okay, it's possible that we missed a transaction. So that transaction has never been journalized. It's possible a correct journal entry was not posted, or that we posted a journal entry twice, or we used incorrect accounts when we made the journal, or offsetting errors are made, and so they mask incorrect balances in the accounts. However, if the trial balance doesn't balance, then we're definitely wrong. And so we need to investigate what could be the result of the error. So there are a few tricks that we can use to help us figure out where the error or where the error is located. So if the error is an amount such as 1, 100, 10, 1000, it's most likely an addition error. We would want to re-add all the columns and recalculate the balances. If the error can be divided by 2, we want to check to see if there's a balance equal to half the error entered in the wrong column. Okay, so it could possibly mean something was entered on the wrong side. If the error can be divided by 9, it's possible that the account balances were incorrectly copied from the ledger. So it means that two digits may have been inversed with each other, and that can result in an error that can be divisible by 9. We also want to scan the ledger to see if any account balances have been omitted. So if possible, we forgot an account entirely. So if we check the difference and it equals an account balance, it's possible that account was missed. So we went over a lot of information today. We discussed debits and credits. We went over journal entries. We talked about posting. We went over two reports, chart of accounts, and trial balance. Now, recommendations are to memorize the debits and credit sides of the T accounts and knowing which side an asset is increased on, which side an asset is decreased on, and doing the same thing for all of the other financial statement elements, such as liabilities, owner's equity, revenues, expenses. We will continue our next lesson on the accounting cycle, and then also we will discuss what happens at the end of an accounting period. And then that brings us to adjusting journal entries. So once we get to this stage, it's really important to understand your debits and credits as we get more and more deeper into accounting. Thank you so much for listening, and we'll see you next time.